Our total risk is composed of business risk, which is also called operating risk, and financial risk. So what do we mean by business risk or operating risk? We mentioned before that our total cost is composed of fixed cost and variable cost. So let's assume that we have a recession, such as in 2020 we had COVID-19 outbreak, which resulted in a recession. Therefore, sales will decrease. What will happen to our cost? Our variable cost will decrease as well, but fixed cost will remain the same. Therefore, which type of a cost will put a risk for the company? It is fixed cost. Therefore, our business risk or operating risk, comes from the use of fixed cost. Then we have financial risk. What do we mean by financial risk? We know that every time the firm uses debt, such as loans or bonds, they need to repay this debt back. Therefore, if debt level increases, this will increase the probability of financial distress, which means the probability of bankruptcy. Therefore, the higher the debt level, the higher the financial risk. Also from the use of preference shares. Because with preference shares, we need to pay periodic dividends. Therefore, how we gonna measure business risk or operating risk? Through operating leverage. How do we measure financial risk? We measure it through financial leverage. So let's assume this is our income statement. Our sales minus operating cost, which is fixed cost plus variable cost, it will give us EBIT, minus interest expense, it will give us earnings before tax, minus taxes, it will give us net income, and then we have shares outstanding. If I divide net income divided by shares outstanding, it will give us earnings per share. Therefore, you'll discover that until EBIT here, from sales to EBIT, this is related to operating risk, the risk of operation, which is related to our operating cost. And then from EBIT to earning per share, this is mainly related to the use of debt and preference share. That's why we call it financial risk. So what do I mean by business risk? This is the risk that comes mainly from our operating cost, and which one in particular? It's mainly fixed cost. Therefore, what is the measure of our business risk? The measure of business risk is beta, which is also called systematic risk. Therefore, what are the factors that will affect the business risk? First one is demand variability. Maybe we have a recession and that's why demand will decrease. There are fluctuations in the demand. Sales price variability. You'll discover that the sales price goes up and down. It has a high volatility. Input cost variability. When you buy raw material, it will be at different prices, and that's why this will increase our business risk. Ability to develop new products. So this means that all the time you need to invest a lot of money in research and development in order to stay competitive. Then foreign exchange exposure. Let's assume that you get your raw material from Italy and then you need to pay in euro. So if the exchange rate changes, this will affect your cost. And then the use of fixed cost over variable cost, which we call it operating leverage. So what do I mean by degree of operating leverage? This is how we're going to measure our business risk or operating risk. So this means that if we have a high variability of sales, if our sales is highly volatile, this will increase our business risk. Consequently, this will increase our operating leverage. And this is how we're going to measure it through the degree of operating leverage. So what will be the formula of the degree of operating leverage? We said that from sales minus operating cost, which is fixed cost and variable cost, it will give us EBIT. So if I get the percentage change in EBIT divided by percent change in sales, this will give us the degree of operating leverage. So how do we get the percentage change? A change, it means new minus old. Percentage change, it means that divide by old. So this means that I need to get new EBIT minus old EBIT divided by old EBIT divided by, do the same for sales. New sales minus old sales divided by sales. So if you check here, how many quantities do we need to have? We need to have 2 quantities in order to get new and old. Therefore, can we rearrange this formula just to use only one quantity? Yes. So we can use this formula and we need only one quantity, which is our degree of operating leverage is equal to quantity multiplied by open bracket price minus variable cost per unit, close bracket, divided by quantity multiplied by price minus variable cost per unit, close bracket minus fixed cost. Therefore, which one will be easier to use? The second formula. Remember, if degree of operating leverage increases, what does it mean? It means that our business risk will be higher. So financial risk. What do we mean by financial risk? Financial risk is the risk that comes from the use of debt, such as loans and bonds or preference shares. Why? Because every time we use debt, we need to pay interest on the debt, and we need to pay part of the debt, which is the principal. As well as when we have preference shares, we need to pay regular preferred dividends, which will increase the probability of bankruptcy of the firm. Therefore, we could say that if we have a higher debt, this would result in higher financial risk. Consequently, our financial leverage will increase. Therefore, it will cause higher variability in our earning per share. Remember, earning per share is calculated as net income divided by shares outstanding, which is the number of shares. And we measure financial risk through something called degree of financial leverage. Therefore, what will be the formula of degree of financial leverage? We need to get the percentage change of earning per share divided by percentage change in EBIT. How do we get percentage change? Get new minus old divided by old. So we'll get new earning per share minus old earning per share divided by old earning per share. All of these divided by new EBIT minus old EBIT divided by old EBIT. Remember, how many quantities do we need to have here? We need to have two quantities in order to use the new quantity and the old quantity. So, can we rearrange this formula just to use only one quantity? Yes. So our formula will be our degree of financial leverage is equal to EBIT divided by EBIT minus interest. So this will be the formula, EBIT divided by EBIT minus interest. So what will happen if degree of financial leverage increases? It means that we have higher financial risk. So what will happen if we don't have debt and we don't have any preference shares? Which means if our asset is equal to equity, it means that there is no financial risk. Consequently, our degree of financial leverage will be 1. So what I mean by 1? It means that there is no financial risk. So what will be our degree of total leverage? Our degree of total leverage includes both operating risk and financial risk, which means it includes both the degree of operating leverage and degree of financial leverage. So this means that if operating leverage increases, it will increase our business risk. Consequently, it will increase our total leverage. The same for financial leverage. If it's higher, it will increase our financial risk. Consequently, it will increase our total leverage. Therefore, what will be the formula of our degree of total leverage? The easiest formula is calculated from degree of operating leverage multiplied by degree of financial leverage. Therefore, this will give you degree of total leverage. Then, what if we'd like to get a formula for degree of total leverage? We know that degree of operating leverage is percent change of EBIT divided by percent change of sales multiplied by the degree of financial leverage, which is the percent change of earning per share divided by percent change of EBIT. This one will offset this one, so this will give us our degree of total leverage is the percentage change of earning per share divided by percent change of sales. Do you remember the income statement that I showed to you earlier? We started with sales and we ended up with earning per share. So I will get the percent change of the last line, which is earning per share, divided by the percent change of the top line, which is sales. Remember, in order to use this formula, how many quantities do we need to have? We need to have two quantities. So can I use this formula, rearrange it to get only one quantity? Yes. So here, if I would like to use one formula, so our degree of total leverage will be quantity multiplied by price minus variable cost per unit, close bracket, divided by, repeat this part again, quantity multiplied by open bracket, price minus variable cost per unit, close bracket, minus fixed cost, minus interest. And with this one, we need to use only one quantity. Therefore, what will happen if we don't have any operating risk nor financial risk? This means that our degree of total leverage will be 1. So this means that if degree of operating leverage is equal to 1, it means that we don't have a business risk. If degree of financial leverage is equal to 1, we don't have financial risk. If degree of total leverage is equal to 1, we don't have neither operating risk nor financial risk. But remember, here we are focusing on risk. But remember that every time risk increases, our expected return will increase as well. Therefore, if we have a very low level of risk, this means that our expected return will be lower.